Hello everyone, welcome to Akira's Academy of Accounting and Finance, and today we are going to do the illustration of dissolution of a partnership firm, right? Because of the limited space, I have tried to manage it. I hope you will get it. So there are three partners, Asha, Nisha and Disha, sharing profit and loss in the ratio of 5:3:2, right? This is their balance sheet, the liabilities, the assets, right? Now first and foremost, what we need to do, what we are not supposed to open any of the assets or liabilities account. There is going to be only one account where all the assets, all the liabilities, all the expenses, all the incomes will get transferred, and we have to deal with that particular account only, and that is realization account. Okay, so there will be one realization account, the second will be the partners capital account, okay, and the third is going to be the bank account, wherein we will give effect of all the transactions that are happening, whether we are selling certain assets, whether we are paying to certain creditors, or we are paying off the liabilities. All the effects will be given in these three accounts only, right? So let us first try to close these all accounts and transfer it to the realization account. So when we transfer the assets, it will come where we close the assets accounts will get closed, and we will debit what? Realization account. So to assets, which assets? First is goodwill, 20,000. I'll write it in the outer column also. 20,000, building 80,000, furniture 50,000, plant and machinery 60,000, investments 60,000, stock 70,000. Daters, now here the daters are there in the inner column, 45,000, and we have kept a provision for bad and doubtful debts, that is 5,000. Now what we need to do, we need to write the gross amount over here. Okay, so the provisions will come over which side? On the credit side. The provision account will get closed. Similarly, it will happen with depreciation. If we are keeping a provision for depreciation, then provision for depreciation will come on the credit side. We have still not utilized those data's amount, so the provisions will come on the credit side, that is by provision for bad and doubtful debts, which is 5,000. Okay, so the gross amount will come over here and the provisions will come on the credit side, right? Cash at bank, so to balance brought down is 60,000, and this is what? Loan to D. I have just kept the initial A and D. D is Disha. So the firm has given loan to Disha, right? So what we need to do, the firm needs to collect that particular amount of money from Disha, right? What will be the entry? Bank account debit to loan to Disha account. The loan to Disha account will get closed. So here the firm has to take money from the partner. Okay, so the firm will take money, so to loan to Disha, this account is closed, and bank account, we will debit the bank account, right? Now all the assets accounts we have transferred. Now we will transfer the liability side capital. So by balance brought down is how much? 1 lakh of Asha, 80,000 of Nisha, and 50,000 of Disha, right? Second is workman compensation fund. Now the firm is getting dissolved. There is no need to pay anything to the workers. So this fund that they kept for the workers will get distributed among whom? Among the partners. In what ratio? In their profit sharing ratio. So by workman compensation fund, it's how much? 10,000. Ratio is 5:3:2. That is, it will be 5,000, 3,000 and 2,000, right? Next is general reserve. All the reserves and surplus will get transferred to partner's capital account. It is 20,000. 20,000 divided by 10 into 5 will be how much? 10,000 into 3 will be 6,000 and into 2 will be 4,000. Okay, done. Next is what? Investment fluctuation fund. Investment fluctuation fund. Why the firm keeps investment fluctuation fund? So that if there is any rise or downfall in the investment, they need to keep it for those investments. So are there any investment? Yes. So they have kept fund for that particular investments, right? If investments are not there, and still liability shows investment fluctuation fund, now the investment are not there, so the fund will be distributed among the partners in the profit sharing ratio, but the investments are there. So the investment fluctuation fund will get transferred to which account? To the realization account. So by investment fluctuation fund, that is 10,000. Bank loan. Okay, now these are the liabilities. Okay, so by bank loan is 40,000. By A's husband loan, Asha's husband's loan, it is 30,000. Then come N's loan. N is what? N is a partner. Now this is what this liability is towards the partner. Now when we pay off the liability to the partner, first we need to pay off the third party liabilities. A's husband is not the partner of that particular firm, so A's husband is considered as a third party liability, wherein N's loan, N is a partner of that particular firm, so N's liability will be paid off after paying off all the third party liabilities. If there is a balance in the bank, then we will pay off. So we are currently not giving any effect to this particular transaction. Okay, we will keep it as it is, and when the firm is having a sufficient balance in the bank, then they will pay off the loan amount to N. Okay, next is creditors. By creditors 70,000 and by bills payable 20,000. Okay, all this is done, right? The balance sheet is all the accounts are closed now, and we have transferred it into the remaining 3 accounts. Now let's go to the transactions and adjustments we need to do. So the first is 50% of the investment was settled against A's husband's loan. Investment were how much? 60,000. Okay, out of 60,000, 50% is 30,000. Okay, they were settled against A's husband's loans. A's husband's loan 30,000 of investment were given to A's husband, so this liability was settled off. What will be the journal entry for it? There will be no journal entry, because against one particular asset we are setting off a liability. Okay, let's say if we sell the asset investment, so what will be the entry? Bank account debit to realization account. Okay, money comes into the firm, so bank account to realization account. And if we pay off any particular liability, what will be the entry? Realization account debit to bank account. Okay, we are setting off the liability. Now here in this case there is no bank transaction. Okay, so what is the entry? R account debit to R account. Okay, realization account is debited, realization account is credited, so there is no need to pass any journal entry if we are setting off any particular asset against a liability. Okay, but what is written? The remaining 50% were taken over by A. Remaining 50% were taken over by A, that is 30,000. At 90% of the book value, 90% of 30,000 is 27,000 less rupees 700 discount, that is 26,300. I hope you got this. 50% of investment is 30,000. 90% at 90% of book value we considered it, that is 27,000. Again there was a discount of 700, that is the amount taken over by A was 26,300. Now this particular investment is taken over by the partner. Now partner's account is there. If some asset is taken over by the partner, that means the liability towards the firm to that partner reduces, because he is taking over that asset. That is, the firm is not supposed to pay that much amount to that particular partner. So 26,300, the liability of the firm reduces because he took over the assets. Okay, now what will be the entry? Partner's capital account debit to realization account. Okay, when any liability is set off against an asset, there is no other particular account. Okay, realization account will only get debited, realization account will only get credited. But if any particular asset or liability is taken over by any partner, then it affects the partner's account, because there is a partner's account. Okay, assets taken over by the partner, that means the liability towards that partner reduces. And if the liability is taken over by that partner, that means the liability of the firm towards that partner increases. If the firm will be having money, they will pay off. If the firm is not having money, they won't pay off for that particular liabilities towards the partner. Okay, so partner's capital account debit to realization account, partner's capital account debit to realization account. Towards Asha, it reduces by 26,300, and by A's capital account, this is related to investment. Okay, 26,300. What is the next adjustments? Bank loan was settled at rupees 43,000. So bank loan was settled, we pay off bank loan. No this thing is there, no account is there. What account will get debited? Realization account debit to bank account. So to bank account, we set off the liability for rupees 43,000 by realization account 43,000. Okay, next is what? N took over 50% of the stock. Let me just erase it. Okay, N took over 50% of the stock at 5% less on its book value. How much is the value of stock? 70,000. Okay, 70,000 is the value of stock. How much N took over? 50%, that is 35,000. This is 50% of 70,000. He took over 50% of the stock at 5% less on its book value. 5% of 35,000 is how much? 10% is 3,500. 3,500, half of it is 1,750. So the amount is 0,5233. 33,250. Right, this is the value at which he took over the stock, and remaining stock was sold. First let's pass the journal entry for this. So N took over 50% of the stock, N is taking over the asset, the firm's liability towards N reduces. What will be the journal entry? N's capital account debit to realization account, 33,250 by N's capital account. This is related to stock. Okay, 33,250. Fine, this one is done. And remaining stock was sold at a gain of 10%. Remaining stock is how much? 35,000. This was sold at a gain of 10%. We will add 3,500, that is 38,500. We sold the stock, money comes into the business, bank account debit to what? To realization account. So by bank account 38,500, bank account debit to realization account, that is 38,500. Done. Got it till this much. The fourth transaction is what? one of the creditors to whom amount due was rupees 40,000 agreed to take over furniture. Okay, agreed to take over furniture. How much is the value of furniture? 50,000. Okay, 50,000. This is the value of furniture, right? And what is the value of creditor who took away this furniture is 40,000. He took away the furniture worth rupees 50,000 and pay the balance in cash. What he is doing, he is saying that I will took away the furniture, amount due to me is 40,000. Okay, I'll take away this furniture worth rupees 50,000. The balance is how much? 10,000. This 10,000 I will pay it in cash. Okay, what will be the journal entry? The creditor, here the liability is taken over by an asset. Okay, he took over an asset. Now, for that there will be no journal entry. For rupees 40,000 there will be no journal entry. There will be entry for just rupees 10,000 because he is paying cash. Okay, that is an income for the business. What happens? Bank account debit to realization account. Bank account debit to realization account 10,000 by bank account 10,000. Okay, fine. Next is what? Where is the remaining creditors were settled at 10% less. So total creditors is how much? Total creditors are 70,000. Total creditors 70,000. Out of 70,000, 40,000 the creditor who was towards whom the liability was 40,000, he got settled by giving him furniture, whereas the remaining 30,000, how we are settling them? We settle their account, but we give them 10% less amount, that is 10% of 30,000 is 3,000, so we are paying them 27,000. Okay, what will be the entry? Realization account debit, money goes out of from the firm, so to bank account. So realization account debit to bank account 27,000 by realization account 27,000. Now what is the next transaction? Bills payable were paid in full. We paid the full amount to bills payable. How much amount was due to bills payable? 20,000. So what will be the entry? Money goes out from the business, realization account debit to bills payable account, to bank account, sorry, there is no bills payable account. So to bank account 20,000 by realization account 20,000. Okay, got it. Next is building was sold for rupees 70,000 and plant and machinery for rupees 45,000. In both the cases money comes into the business. What will be the journal entry? Bank account debit to realization account. Okay, bank account debit to realization account by bank account. First we sell off the building for 70,000 and machinery by bank account. We sold off the machinery 75,000. So bank account debit to realization account for building 70,000 and again to realization account for plant and machinery, that is 75,000. Okay, this was simple, easy. Next is was debtors realized for rupees 42,000. Debtors give back the money. How much they give? 42,000. Bank account debit to realization account 42,000 by bank account 42,000. Next is what? And rupees 2,000 were recovered for bad debts written off last year. We took write off that bad debts. Now those bad debts have paid the money. Those debtors have paid the money which we already write them off. This is what? This is an unrecorded assets. Okay, this is not recorded. We get the money. It's kind of an income for the firm, right? Income, which side it will go? On the credit side. Expenses, which side it will go? On the debit side. just and just on the realization account, because there is no other account. So we recovered that much amount of money, 2000. What will be the entry? Bank account debit to realization account. So to realization account 2000. Okay, next is an unrecorded liability of rupees 3000 was paid. We pay off a liability. Okay, that is liability is not been recorded in the books, but that is kind of an expense which we are paying it off. Which side what will be the journal entry? Realization account will get debited to bank account. So to bank account. By realization account, this is an unrecorded liability. Next is N took over the dissolution work for which she was allowed a remuneration of rupees 10,000. One of the partners say, okay, I will take all these things, all the work of selling of the assets and all these things, and for that I need a remuneration. So the remuneration is being paid to whom? To the partner. What will be the entry? Realization account debit to partner's capital account, to N's capital account. How much it is? 10,000. Okay. By realization account to Nisha, right? 10,000. What she's saying, and agreed to bear the dissolution expenses up to rupees 8,000. Okay, how much she is agreeing to bear? Up to rupees 8,000. Like if the dissolution expenses are till 8,000, I am ready to bear that much of dissolution expense. But if it increases, then the firm needs to pay me off the remaining amount. But what happened? Actual expenses amounted to rupees how much? 9,500, which were paid by N. So this expense 9,500 was paid by N. How much she agreed to bear? 8,000. So what we need to do? We need to pay 1,500 to Nisha, right? So 1,500. This is an expense again for the firm. So and we need to pay to Nisha. So realization account debit to N's capital account. By realization account, we need to pay 1,500 more to Nisha, right? Now this thing you need to understand. If at all the actual expenses amounted to rupees 7,000, right? No need to pay. If there is no such there's no such kind of things like N said, I'll take over the dissolution work, you need to give me the remuneration, and if there is no such thing that I agree to bear this much expense, then whatever may be the expense, even if it is mentioned, we are not supposed to pay. Let's say if N says that I'll take over the dissolution work for which she was allowed a remuneration of 10,000. This is one statement, and the other statement comes, the actual expenses amounted to rupees 9,500. Okay, so 9,500, there was no such agreement earlier like from Nisha that I will agree to bear this much amount of expenses. Here in this case there is an agreement that she agreed to bear the expenses till 8,000, but actual expenses amounted to 9,500. So 1,500 the firm needs to pay to Nisha. So I hope you got all these transactions. We give effects of all these transactions. Let's see whether there is a realization profit or loss, right? Okay, so the calculation, when I calculated, okay, I didn't wanted to waste time, so just I paused. So when we calculated the whole thing, the debit side comes to 4,89,500, whereas on the credit side it comes to 4,72,050. That means debit balance is more as compared to the credit balance. What does it signify? That there is a loss, okay, by loss on realization. Okay, loss on realization. How much is the loss? 489,500 minus 4,72,050, that is 17,450, and this loss will be shared among the three partners in their profit and loss sharing ratio. That will be how much? Into 5, that is 8,725. For Nisha it is 5,235, and for Disha it is 3490. Okay, so this will be debited on the partners capital account. So loss on realization for Asha it's 8725, Nisha 5235, and Disha is 3490. Now this is done, all the liabilities are being settled, but you need to remember, highlight this thing, right? Liability toward a partner is still remaining, so we need to pay off, and we need to see that bank is having sufficient balance to pay off the liability or not. So how much it is? 60,000 plus 10,000 plus 38,500 plus 10 plus 70 plus 75 plus 42 plus 2000, that is 3,07,500. And if we minus the amount, 43 minus 27 minus 20,000 minus 3,000. Yes, bank is having sufficient balance, so now bank need to pay towards the liability towards a partner. So by ends loan account will get closed and bank will pay 20,000. Okay, this is a separate account. Partners loan account is a separate account. We are not merging it with partners capital account. And if we pay 20,000, it comes to 1,94,500, and this 1,94,500 will be equivalent to the amount that that will be paid to the partners. If you will calculate how much it comes, 1,15,000 and 89, 99, 99, 1,556,000. Okay, and how much is due to them? 115 to Asha, it is 26,300, that is it is 79,975. For Nisha it is 1,05,500 minus 33,250 minus 5,235, that is 62,015. And for Disha it is 56,000 minus 3,490, that is 5,250. And when I add all these things, 6215 plus 79975, it is equivalent to the amount remaining in the bank, that is 1,94,500. I hope you got this illustration. I hope you got the concept related to the dissolution of a partnership firm. Consider realization account as the asset account, liability account, expense account, and income account. So whatever, you just need to remember the rules of debit and credit. Okay, apply those rules. There are 3 accounts. Apply those rules to all these 3 accounts and your problem will get solved. I hope you got it. See you in the next video. Till then, thank you very much.